Well, gold knows this. And that's why gold's done what it's done. Especially for the last year or so, since March of 2024, when it came up through 2000, fourth time. And now we have a sharp pullback in gold. We understand that I don't pay too much attention to internet chatter, but a lot of analysts on the internet have been saying, gold's got to collapse. It's overdone. This looks like 1980. This looks like 2011, et cetera, et cetera. And finally, they've been saying that for a couple of weeks, by the way. Finally, it did that. We had a very sharp drop in the last 48 hours. Now we're up today. And they no doubt think that was it. We were right. And we argue, no, you're not right. It is highly unlikely a top. That's just another teeth-shattering drop. And unlike most of you go back there to 2020, yeah. Go back to 2024, well, yeah, right there. That's when gold came up through that 2000 price level again in early 2024. And we said, okay, the sleepy zone that gold had been in since 2020, namely in a basically horizontal zone, is over. We're going up, and it surged. But look at the layered, time-consuming congestion zones and corrections that occurred over the last year. Mm-hmm. This one, the last one we had, a couple weeks ago, a month or so ago, was a very quick one, a huge red bar to the downside. Then we're jolted back up, and now another jolt to the downside. But they tend to be quicker and over with quickly. And we don't think this was the top. There's a couple reasons for that. And we think that right now we're on the cusp, partly because of the gold pullback, but silver has pushed back up relative to gold in the last couple of days. If you'll notice, and this has got to be very confusing to silver folks, gold collapses in a 24, 48 hour period, and yet silver goes up each of those days. What the heck is going on? And I think what's going on is silver right now has been priced. You're going back there to May of last year, so almost a full year of, you could draw a line sideways on silver. And we've been either side of that $33 high that occurred in May of last year. So we're coming up to May of this year, so it's been 12 months, and they've been selling it, and we've had a third sell-off. And this third one really looked real to most people. You went down and blew out the prior low that had occurred late last year. So you actually broke the what you might call an uptrend for the price folks. Look what happened after that, an immediate thunderbolt back up, not just a day or two, but persisting now into 3 weeks. And now we're back pressing up, trying to get to 34, for example. And we think even touching 34 is a big tell. You ever touch 35 again, and if you're a point and figure guy, X's and O's, right. $1 and $3 down, and you've got a double top up there at 35. I say top, meaning a flat structure. You go back to 35 a third time, you're going to have a triple top breakout. Silver does not top with double tops, much less triple top. When you get back to 35, that's when I think silver is going to get electric, where you're going to suddenly get, on a macro basis, what we just saw the last 2 days, namely gold down, silver exploding. Now, I don't think gold is going to keep going down, by the way, but I think that what we just saw there was a shift in that spread to where silver is now back up to 1% of the price of gold, which in itself is historically very low. It's a bargain on a relative basis. And I think that's about to shift. I also think the gold miners are about to shift to outperform versus gold. And it won't take much there. Now, you don't, historically, if you go back and look at just the spreads, silver versus gold, gold miners versus, whenever they break out on a relative performance basis versus gold, that never means gold's going down and they're going up, or gold's going down and they're going down less. What it means is you're actually going to enter an accelerated phase in the price action of the markets. And I think that's what we're looking at right now.
I've said it before, but we've officially crossed into the territory where gold is no longer whispering. It's shouting. This isn't some speculative frenzy. This is a macro level shift, unfolding on the charts, showing up in our momentum analysis, and most importantly, confirming everything that's been building for years under the surface. I don't care if Wall Street's asleep at the wheel. The message is loud and clear if you know where to look. We're entering the acceleration phase. Gold knows it, silver knows it, and the miners, they're beginning to smell it too. Let's go back a bit. When we came up through 2000 in March of 2024, that was it. That was the fourth attempt to get through that ceiling, and this time it wasn't polite. We didn't tiptoe across that threshold, we blasted through it. The difference is that, unlike the false starts we saw between 2020 and 2023, this move didn't stall out. The horizontal chop we saw for nearly 4 years finally broke, and when that kind of structure collapses, it usually doesn't drift upward gently, it surges. We've seen this before. You don't spend 4 years coiling a spring, forming congestion zones, layering in resistance and failed breakouts, without eventually triggering a slingshot. And that's what this is, a structural release of pent-up pressure. You don't need to read the news to know what's going on. The chart is telling you everything. And what's fascinating here is how the public and financial media are still fumbling around trying to come up with an explanation. Is it inflation fears, geopolitics, Fed uncertainty? Number its price structure. This was coming with or without a headline to blame it on. When momentum structure breaks down, the fundamentals catch up later to rationalize it. Now let's zoom in a little bit. Gold's pullback recently, a sharp one no doubt, has people jittery. It dropped fast, and sure, that triggers all the familiar narratives. It's 1980 again, it's 2011 again. We're in the blow-off top. But let me be clear, no, it's not. Those events came at the end of long, matured bull trends. This move isn't mature yet, it's just getting started. The kind of sell-off we just had? That's teeth-shattering, yes. But it's a correction inside a trend that remains firmly intact. It's what happens when too many traders pile in and get too aggressive. It's a good thing. You want to see that kind of shakeout early in the run. It gives us a firmer launch pad for the next leg up. And let's not forget what silver's been doing during that pullback in gold. You want to talk about confusing the consensus crowd. How about silver rising while gold was dropping? 2 days in a row, silver up, gold down. That's not noise. That's not confusion. That's a transition. That's a spread shift. And that brings us to one of the most important pieces of this whole puzzle, the silver-gold ratio. For most of the last year, silver has lagged, but when you look at the historic context, especially going back to the 1980s and 1990s, this ratio is absurdly stretched. Silver below 1% of the price of gold? Come on, that's not just undervalued, it's begging for mean reversion. We're not asking silver to do anything spectacular. All it has to do is move back to the bottom end of its historical range. And you're talking about an explosive catch-up trade. And then there's the miners, GDX, GDXJ, SILJ, you name it. Everyone's been sitting around waiting for these names to catch fire. I've been saying for months that the structure is there. All it needed was a catalyst. Well, guess what? That catalyst is here. And it's not some Fed announcement. It's not a geopolitical tweet. It's price. Price is the catalyst. The ratio of miners to gold, whether you chart it via GDX/gold or XAU/gold, has broken out of a decade-long base. Do you understand what that means? We're not talking about a little technical wiggle. We're talking about one of the longest, most suppressed sectors in the market finally breaking the chains. And when that happens, you better believe the upside is going to be jaw-dropping. If you look at historical precedent, particularly from the early 2000s, when miners finally broke out after years of underperformance, they didn't just rise, they multiplied. 5 baggers, 10 baggers, 20 baggers. And most investors didn't touch them until after they'd already moved. That's how it works. The early phase belongs to the few who are watching momentum, not the rearview mirror, but the future. Right now, we've got GDX trading as if gold is still stuck at 1,800. It's not. We're above 3,000, folks. And yes, there are concerns about margins, cost inflation, and jurisdictional risk. But those concerns don't justify a disconnect this wide. When earnings reports start rolling in over the next few quarters and margins surprise to the upside, these names will get re-rated fast. We're already seeing it. Just look at Newmont. They beat earnings by 42%. Revenue was up 25% year over year, and profits try 127% quarter over quarter. And how did the market react? Shrug, a 2% move in after hours. It's ridiculous. At some point, this complacency will break, and when it does, these gold stocks will be the only sector moving up while everything else bleeds red. And what happens when the broader equity markets start to realize they're in a topping phase? All that passive capital chasing the Magnificent Seven or the AI trades. Where do you think it goes when those trades unwind? Into safe, tangible, productive assets. Into gold miners with high margins, real cash flow, and explosive optionality on rising metals prices. The funny thing is, you don't even need a bullish gold forecast to make this trade work. You just need reversion. Just take the gold to miner ratio back to its historic mean and you've got a multi-bagger setup. Add in a rising gold price, and the leverage on these miners is extraordinary. And yet, barely anyone's paying attention. We're in this odd moment where all the indicators are flashing green. Technical breakouts, macro confirmation, structural scarcity, and still the sentiment is dead. It reminds me of late 2018, early 2019. Nobody wanted miners, nobody wanted silver, and yet that was precisely when the shift began. That's where we are now. The shift has started. And like most generational transitions, it's going to happen gradually, then suddenly. Gold already crossed the Rubicon. Silver is about to explode higher. And the miners? They're about to go from ignored to irreplaceable. And if you're not positioned before that happens, you'll be chasing candles, just like the crowd always does.
Go ahead. Stock market is breaking down. The breakage we saw into early this month, low on April 7th, was in fact real, a trend direction move. In fact, we broke momentum structures, not price, back in January for the S&P and in early March for the NASDAQ 100. And then we had the gusher that followed after that NASDAQ break. We dropped precisely to a level that we had predicted in MSA would be a bounce point. Not a bottom, just a point where bargain hunters would come in thinking, oh boy, a corrective pullback, I can get long. And the number was 16,500 on NASDAQ, and boy, its low was right around there. And for the S&P, it was 4,800, and it stopped at 4,830. And we've had a huge bounce that came 48 hours later. It was the April 7th, a Monday, stabilized on Tuesday, and then Wednesday shot up enormously. That's when Trump said, again, the market seems to behave by the wishes and the wands of government. A 90-day pause, okay? And they said, oh boy. So they rallied sharply. It's now nearing the end of the month, and finally, the rally high that occurred on that day, the 9th, which has been the top of all the action all month. We've gone up to it 2-3 times and not been able to get through that price high, that rally high. We're nipping it out right now, thank goodness. And the reason, you get those last half a dozen candles that looks like a daily there or something. Yep. But that big green candle you see there, we're finally nipping out that high after a couple efforts to do so. And so that would no doubt turn on price chart folks. Oh boy, a bottom's completed. We broke out over the ceiling.
Right.
Well, momentum is chuckling at it. Momentum says, you're broken, guy. You want to try to get off the street and get on the curb, fine. But that breakout, which I'd like to see, because I want to see what happens. Meaning, once you do that, there ought to be a big party, right? Okay, everybody's, oh boy, it's bottom, it broke out. It's when that breakout fumbles. A couple days from now, or maybe the same day you break out, that's when disappointment starts, because they think, oh, I had a low and I broke out of a base, but the base wasn't valid. And so I suspect that's going to happen. We're going to take out that high if we haven't already while we're talking. And let's see what happens. We argue that no, it's a baloney rally. And if you look at it another way, since that low near 4,800 on the S&P on the 7th, you've spent 3 weeks now spinning and spinning, but really not doing much better than you did hours after that low. Mm-hmm. And again, we had another government from above announcement, namely, no, I'm not going to fire Powell. After the day before, he's going to fire Powell. And so the market is like a bunch of little kids, and the daddy's throwing them candy. And that's not how markets move. If you think you can buy a market because, the government says something, then, do so if you want. We think the market is fully broken, and this is merely a pause, a bounce. And obviously, massive disappointment is going to come in if you ever roll back over. I think when you roll back over through the low we saw early this month in the NASDAQ and the S&P, that's when people are saying, my gosh, we didn't hold on top of the 2022 highs.
Let's pick it up right where we left off. The crowd isn't just late to this gold party. They don't even know it's happening. They're still chasing tech names at 30, 40, 50 times earnings, trying to convince themselves that Nvidia is a bond and that the Fed can navigate its way through a minefield without detonating the entire financial system. That's not just wishful thinking, that's delusion. Meanwhile, gold is quietly, and I do mean quietly, being reintegrated into the monetary system. It's not a theory, it's not a possibility, it's happening. The COMEX is being drained. The LBMA is pushing delivery dates back 8 weeks, claiming it's a truck shortage. Sure, just like the dollar shortage in 2008 had nothing to do with leverage. Let's be honest here, we're witnessing the slow motion panic of a system that knows the game is changing. Now the evidence is piling up. Since November, the US has become a net importer of gold, something we haven't seen in decades. That alone should turn heads. But it hasn't. Why? Because the narrative hasn't caught up with reality. And by the time it does, it'll be too late to get in at current levels. Let's talk silver. This metal is the coiled spring of the century. I've said this before, and I'll say it again. Silver doesn't play nice. It sleeps for years, and then it moves 50% in a month. And when it does, you better already be holding it, because trying to chase it is like trying to lasso lightning. And what we're seeing right now is textbook. A false breakdown below 28, a face-ripping rebound to 33, and suddenly that 35 level isn't a resistance, it's a target. One more push through that, and you're going to see every fund manager who laughed at silver scrambling to put together some kind of position. They'll call it tactical exposure. You'll call it too late. Let's go back to something I mentioned earlier, the miners ratio to gold. GDX divided by the gold price gives us a performance ratio that's been suppressed for a decade. Historically, that ratio oscillated between 0.20 and 0.35. At the bottom in 2015, we dropped below 0.06. Right now, we're flirting with 0.08. If that ratio simply reverts to 0.20, and remember, we don't need gold to move an inch, GDX would have to triple from here just to normalize. Now, layer in rising gold prices, a collapse in faith in paper assets, and an eventual rush into hard asset equities. And that's how you get multi-100% moves in these names. And I want to remind everyone, this isn't a fringe trade. We're not talking about penny stocks or exploration companies in the jungles of Africa. We're talking about companies like Newmont, Barrick, Agnico, producing cash flow, dividends, reserves, solid businesses, mispriced because Wall Street doesn't understand the cycle. They will. Now, what about the S&P? Let's zoom out. Everyone's been trained to buy the dip. That worked for 15 years. It won't work anymore. You don't buy the dip in a topping phase. That's how you get buried. The momentum break in the S&P 500 that we're seeing now isn't a pullback. It's a structural failure. And when you combine that with rising gold and silver, it's the same setup we saw in 2000, 2008, and to a lesser degree in 2020. Except this time, the size of the debt pile and the global derivatives exposure is exponentially larger. So what happens when confidence breaks? Not in the Fed, but in fiat itself? Because that's where this is going. We've already seen central banks, especially in the global south, dumping treasuries and buying gold. China, India, Russia, countries that don't have the luxury of pretending the dollar is infallible. And what they're doing is front-running the monetary reset. They're not waiting for an announcement. They're acting. And what's Wall Street doing? Buying Bitcoin ETFs and calling it a hedge. You can't make this stuff up. Now here's the kicker. All of this is happening before the retail investor wakes up, before institutions start buying physical in size, before sovereign wealth funds start allocating to miners, before pension funds realize that a 5% position in gold stocks can hedge their entire portfolio. You're early, you're not late. And let me make a bold prediction. We're going to see a month, maybe this year, maybe next, where silver goes up 50% and gold moves $300 in a week. When that happens, you'll get re-ratings across the board. Not because fundamentals changed overnight, but because the recognition wave finally hit. That's when you'll start seeing Bloomberg panels with 3 people saying, "I don't know why I never considered GDX." That's when you'll see a Goldman Sachs report saying, "We're initiating coverage on First Majestic with a $50 price target." And that's when you'll know it's no longer early. That's when you'll know the crowd is here. But right now, you still have the opportunity to position for that re-rating. You still have silence from the financial media. You still have gold priced like it's just another commodity instead of the base layer of the global monetary reset. So what do? You don't flinch on drawdowns, you buy them. You rotate into miners from general equities. Not all at once, but gradually, methodically, like a professional. You want to take advantage of a system that has mispriced risk for a generation? This is your chance. And finally, you tune out the noise. The trolls on social media yelling double top, the headlines that say gold is overbought, the analysts who have missed every major move in metals for 20 years suddenly offering advice. Ignore them. Because here's the reality. Gold is already acting like the reserve currency of last resort. Silver is staging for a parabolic breakout. And the miners, long left for dead, are about to become the only game in town for investors who want real assets with real leverage. You don't get many moments like this. The last one was 2001 to 2011. The next one has already begun. The door is still open, not wide, but open. Walk through it, because when this thing runs, really runs, you won't have time to think. You'll only have time to chase, and we don't chase. We position, we wait, and then we ride the acceleration.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.